What's up everybody, this is Jack from Crypto49er bringing you my knowledge in cryptocurrency. So today I want to talk about why the MACD is better than the RSI. But before I do, just want to remind you guys I'm giving away $10 on Steemit. In order to win, you have to upvote my Wednesday post on Steemit, re-steam the post, and to answer the trivia question that I'll be posting on Wednesday's video. Alright, on to today's topic. Why MACD is better than RSI. So this is a chart of Ethereum USD trade pair, and you can see I have both indicators, the MACD and the RSI here. And the very basic idea of using these indicators are as follows. So with the MACD, all you have to do is wait for the blue line to come up from under the orange line. That means you're supposed to buy when that happens. And you're supposed to sell when the blue line goes under the orange line. It's just that simple with the MACD. Similarly, it's the same with RSI. You have to wait until, let's go back here. So when the RSI drops below 30, that means it's oversold. That's the time when you should buy. And similarly, when it's at 70, that's when you're supposed to sell. Very simple, basic ideas on how to use the RSI and the MACD. But here's the thing. The MACD gives you so much more information than the RSI alone, because RSI is literally just a line here and then they just give you two bars, the 30 and the 70. And the other thing with RSI is, if you look at the chart here, for example, if you sold at 70 right here, you would miss out on all the gains, right? Because yes, it was overbought, but then it continued to stay overbought for a while. But compared to the MACD, you can see at the same level here, you bought it over here, but actually you bought it right when across, and you stayed in it because look, you would have sold right around here, but instead you could just stayed right in it and capture much more profits. Even after the dip, you still capture a lot more profit. So that's the difference. First of all, I mean, people can argue that you can say you can wait until the RSI drop below 70 before you sell. That's definitely one way to do it. But besides that, let me go dive deeper into the MACD and explain why I think it is a better indicator, even though it is a lagging indicator. Alright, I'm closing out the RSI for now, just showing you guys the MACD. So the basic idea of the MACD, the blue line that you see here before, is actually a combination of two lines. It's a combination of the 12-day EMA and the 26-day EMA. The combination is actually calculated by subtracting the 26-day from the 12-day EMA. So that's how they were able to create the MACD. When I first started using the MACD, I was confused and thought, hey, why don't you just put the 12-day EMA and the 26-day EMA on the graph and you simply have your MACD? That's not how it works. But I'll just show you guys what it looks like, because obviously I could have made them the same colors, but I don't want to because I want to make sure that you guys see the difference. You can see that they do look similar. The yellow line looks like the MACD line, right? The blue line here is the MACD line, and the yellow line looks like it. It kind of comes in the same similar pattern, but doesn't match exactly. And again, the green line looks similar to the orange line, but doesn't quite match exactly. You see the cross right here for MACD, but then cross yet over here. So what's going on? What it is again, these two lines, the yellow and green, actually combine to make that one blue line, the MACD. And then the orange line is actually a signal line. The signal line is actually the 9-day EMA, and that's like a much faster moving line. So it reacts to the market much faster than a 26-day or even higher day count EMA, like a 26-day or like some people use a 200-day for the Mayer multiple, for example. But the smaller the count, the quicker it reacts to the market, but it is still reacting to the market, so it is a lagging indicator. The line actually forms as the market goes, so by the time you see it happening, it's already too late. The market condition already happened. So that's why people don't like the MACD. But there's this thing called the MACD histogram. As you can see here, the MACD histogram is actually interesting. The MACD histogram is actually the difference between the orange line and the blue line. The greater the difference, the greater the number in the histogram. If the MACD and the signal lines really fall apart, you can see that right now 0.9 here, and then it's more further apart with 0.96. And when it crosses, it's practically zero. So basically, when the MACD crosses the signal line, it's practically zero. So that's just like an interesting fact. But then to use the MACD histogram, all you have to do is see the pattern of it. You can see how it's diving downwards. You can even draw trend lines with it. And you can see that in this case, it's diving downwards. So you can see that it was already trending down. So basically, even though the MACD haven't crossed down below the signal line, you can see by the MACD histogram and the trend line that I drew that it's already curling downwards and is signaling that you should get ready to sell. Then that way you'll be able to profit up here and not sell over here. So you end up making $4 extra in gains compared to closing in one candle later. So just that alone, that in itself is very important in the sense that this is something that the RSI does not tell you. So you can have the RSI look at the overbought condition. I'll bring back up, but it doesn't really tell you. You can see even the trend lines were still trending upwards. So it doesn't really tell you exactly. I mean, I guess if you draw a trend line over here, you can kind of argue that this is heading downwards. So you can say that you should have sold here if you're very knowledgeable in knowing how to use the MACD. But overall, it just doesn't tell you when the market is bullish, when the market is bearish, because you kind of have to know the numbers. And if you follow Constant Brown's RSI rules, I think it's between like 20s to 40s is bearish, and then 30 to 60 is neutral, and then 40 to 85 is bullish. But as I just said those numbers, you can hear that a lot of them overlap and it gets confusing. So that's why the RSI just doesn't work as well in my opinion. But here's another thing that you should know. So I'm closing out the RSI again, but I just want to show you when the MACD crosses. If you look at the MACD components here that I have drawn up, this chart here with the 12 and the 26, when they cross, what happens here? Look at it. When the 12-day and the 26-day EMA cross, the histogram's at 0. So that's something that you have to notice here. So same thing again, when it cross here, it's supposed to be around 0. So that is the idea. So every single time the 12-day and the 26-day cross, you can see that right here, the MACD is supposed to be at 0. And I'll show you one more example where the MACD is supposed to be 0. So let's just go right over here. The MACD is at 0 when these two lines cross. So now why am I showing you this part? Now this to me is the most important part, and this is the key reason why I believe MACD is better than RSI. You can see on the right axis here there's 0, there's negative, and there's positive. With the MACD, all you have to do, in addition to that one little thing that people use, which is say, oh, wait for the blue line to go above the orange line is to buy. But if you add this one key strategy to that very simple process of when to buy and when to sell, instead of simply buying when the blue line crosses above the orange line, look at when they cross. Okay, so right now in this case, it crossed when the blue line was already above 0. So in this case, you can see that it didn't last very long. It was a very short period, and there was just not much in terms of momentum. When you bought into here, you're practically making nothing. You might even lose money. If you bought at the top of this very candle and you just sold around here, you would have lost money. But if you buy in when the MACD crosses the signal line in the negative territory, you're almost always guaranteed to make a profit. So right over here, you bought in right over here when it's negative 3.51 in terms of the chart here on the MACD. So you bought it right over here, and then you sell over here, you would have made a profit. And you can just go through this over and over and over again. So again, here, you bought over here, and then you can sell over here, you would make a profit. Might not be very much because it didn't go very high, but you are making a profit. And inversely, if you bought it over here and you sold it over here, you would make money. So it's not always the case that you have to wait until the MACD is in negative territory before you buy into it. So in this particular case, it's a good example. You would make profit by just following the first part of the rule and not the second part. But there are more often times than not, I can say, that you'll make a much greater profit by following this rule when the MACD is in negative territory and then selling it when it's in positive territory. I just want to show you guys some good examples here. These are still you make some profits. Again, they're not great profits. So here's a good example right over here. So the blue line crossing over above the orange signal line. But this is when it's in positive territory. And you can see that when you bought it here at 417 and then you sold it here at 416, you will lost money. I mean, granted, it's very little bit, but you still lose money in that trade. And again, even up here, same exact situation. So again, you also see the other thing is when it's above, when the blue line, when the MACD is in the positive territory, those peaks that go up is very, very weak. Like this one right here. So you buy at 417 and then you sell at 415, you will lose money. And it's almost the same every single time. And it only lasted like a few candles. Again, this is like this is about an hour and change. And this one's even shorter. So you buy over here, maybe you buy one candle before, around there, let's say, and then 414, you sell it either 415, you're lucky, more likely you sell here, 411, you will lose money. So it's just that simple. Adding this one simple rule, adding this one simple extension to that rule to only buy when the MACD is in negative territory makes it so much more profitable. And that's the reason why I believe that the MACD is a better indicator than the RSI. And just for comparison purposes, let's bring back the RSI here and let's look at how it would deal with those situations. You'll be buying in the negative territory. It's not very negative, but it's negative enough that you say that the MACD is in negative territory, so you buy over here. But in here, you're thinking you're not really given a clear signal by the RSI. So that is the problem right off the bat with the RSI. You just don't know. You're like, oh, I don't know, like, should I buy it or not? It's just, there's no clear indicator from the RSI. And now the sell part. So if you sell over here, you are selling into positive territory. The price was $3.95 when you bought here, and you sold here as $4.10. With the RSI, you don't really know when to sell. You're like looking at it, it dips slightly, but it could still come back up. It looks like it has some energy. Even if you draw a trend line over there, it's telling you that it's going downhill. So, but you know, it's one of those where you don't really know. So one final thing before I go, I just want to show you that I'm coming up with a strategy in terms of using the MACD as like a momentum trade. I don't think the strategy is quite ready yet, but as currently from my testing anyway, this strategy from a $1,000 investment, I'm able to make $446 in the quote-unquote bull market of February 1st to February 28th. But not the whole entire thing, because it takes a long time to backtest this strategy. And I so far only backtested 10 days. In 10 days in the bull market, I was able to make $446 with this strategy using the MACD momentum. And then even in the bear market, during March 1st to March 31st, again, I just picked the worst particular time because this strategy has a lot of entry and exit points. So I picked the worst particular time, which for my findings was March 5th to March 15th. During that time in that month, this strategy still was able to make $100 with a $1,000 investment. So this is a pretty damn good strategy in my opinion. I don't think it's quite ready for me to talk about it today. I'll probably talk about it in another video. I just want to let you guys know this is my belief with the MACD, and that's why I rely on it a little bit more than the RSI. Even though I still do use both, but I do think that the MACD is a little bit better. So anyway guys, that's my video for today. Let me know what you guys think. Leave a comment down below. Upload this video on Steemit. Re-Steam this video if you like this video and if you like the topic that I cover in cryptocurrency and technical analysis. If it isn't crypto, it isn't worth mining, it isn't worth speculating. I'll see you guys tomorrow. Peace out.